Hi everybody. In this video, we're going to take a look at AP3B from Chapter 12, and this will be the first in a series of videos covering the workbook exercises in here in Chapter 12. So the first problem we're going to look at, as I mentioned, was AP3B. And in this problem, we have the snip here of the workbook exercise information. We've got some journal entry space, and then we've got some tables here we're going to fill out. So, okay, let's read through the problem here. So this tells us that on July 1st, 2018, this company, Merit Company, borrowed a $200,000 note payable with a term of 4 years, annual interest rate of 5%, and $50,000 plus interest is payable every June 30th. And we borrowed it on July 1st. So essentially it's going to be exactly, 1 year later, basically up to the last day before the next July 1st, that a payment will be made. The company has a June 30 year end, and the company prepares adjusting entries and financial statements only once per year. So in other words, we're not recording any interest expense until we get to the end of the year, is what it's telling us. In other words, when we do our journal entries here, we're going to need to record as much interest is applicable for the time period that has elapsed up until the end of the company's year end, essentially. So, okay, well, let's start filling out some of this important information here. And so we can just fill most of this out with what it tells us above. And I just always like putting the information down into a kind of a table format, so it's a little easier to work with. So we've got $200,000 is our loan principal. That's the total note. And then remember that sorry, my phone alarm went off. Remember that the loan principal is the amount that you borrow, and it's also the amount that the interest rate is calculated on. Okay, the loan term is, I think it said 4 years. So we're going to have this thing starting July 1st, and it's going to go through 2018. It's going to go through 2022. Okay. The interest rate was 5%. So we'll put that in. The payment date will be annually, and we'll say June 30. Just put that in so we've got it nicely laid out. I mean, it's up here, but I think it's good practice just to organize your information effectively. The beginning date, we had July 1st, 2018. The company year end is June 30. Okay, now we have to actually do a little bit of calculations. So the annual interest then would be, for example, and maybe I'll include here first year annual interest. In your version, sorry, bear with me here. In your version of this template in Excel, I'll include this will already be updated for you. You will need to fill the table out, but I'll include that here because that number will change. Okay, what happened there? We need to change that. So 5% times the 200,000 of principal means that for that first year where 200,000 is outstanding, we're going to owe $10,000 over that whole year. And if we want to figure out the monthly, we just divide that by 12, and we get $833.33 for every month. Okay, so with that information, then we can look over here and kind of start filling out our table here. So the note began on July 1st, and so each month, at the end of that month, we're going to record, or we're not going to record it because it's telling us we only record it once a year. But if we wanted to figure out how much interest has accrued and how much we owe to that point, we could just fill this out. So we could put equals that amount for that whole first year. That is going to be the case. And so at the end of the first month of July, our total accrued interest, the total amount that we have to that accrued to that point is just the same as the 1 month's worth. So I just linked in, you can, linked to that cell. So I just put equals the I-25. So just linking there because every month is going to be the same for that first year. And then I clicked into the formula and clicked F4 to put the little dollar signs in. And what that does is when I drag this down, it continues to just reference that same cell. And it doesn't drag. If the dollar signs weren't in this formula, it would just continue to go down this way instead of staying right here. So that's what we want. Okay, now to calculate our accrued interest, we're just going to add each month's interest in, on top of what we already had. So for the first month, it was just that 1 month. But then every month after that, it's going to be the previous balance plus the current 833. So we can just do a formula saying add the cell or take the cell above and then add the cell to the left. So take this as our starting point, add the current months in. So at the end of the 2 months that have now passed, we now owe 1,666.67, right? And once we have this formula working, we can just drag this down because then it will just continually update and go down one reference and continue to increase. So then we can just drag that here and you can kind of see how my cursor go over the edge where it turns like a black kind of a cross thing there, and then left click, and this is how you drag the formula down. And as you can see, we end up with $10,000 of interest, which is what we would expect over that whole period, right? And if at any point, because in the real working world, or I'm kind of wanted to do this just to highlight a more realistic scenario here for this problem, is that you'd want to accrue this interest every year most likely, and so you'd want to book a journal entry for this amount. Our problem says we only do it once a year, so that's not a big deal, but I just wanted to have you all kind of understand how that would kind of play out over an actual year. Okay, and then as far as the principal goes, when we first take out the principal, it's $200,000, and then it tells us that we're making a $50,000. I should probably put that in here as well. Let's say annual principal payment, and that was $50,000. So we're just basically spreading this 200,000 over the periods here. So if we want to just do it with a negative sign, so on June 30th, 2019, we're going to make a payment. And so at that point, again, you can do that same formula, the above. In this instance, I'm doing plus the it's a negative, so we're subtracting that amount. So then it becomes 150,000. Oh, that didn't work. Let's just go in here and copy. And I'm just going to do Control V to paste, and paste. Each payment is the same. Another way we could have done that again is just to reference that cell. That's probably a better way to do it. Click into your formula, F4 to put the dollar signs, and then make it negative so it just shows as a payment. And then we can just drag that down, and then each one of those refers to our information cell there. And then again, we can just drag this formula down, and you see how this thing here, as far as payments go, will eventually be 0. And yeah, the one thing you'll notice is after 2019, our principal balance here would be 150,000. And so for that year, it wouldn't be 10,000 of interest, but instead it would be 7,500. I'm going to undo that, but I just wanted to show how the interest will continue to decrease because the principal outstanding decreases over time. Okay, so that was a lot of work. Let's look. This problem's relatively basic, but I wanted to just make it a little more fleshed out so that you all could have a little bit of practice and hopefully maybe understand what's happening here a little bit better with the detail. So it asks us to prepare the journal entry to record the cash receipt, and so that's pretty basic, right? Our date that the note began was on 7/1/18. And we got cash, right? That's what we're saying is cash is going up. I'm going to link to the cells here, use our little notes there as much as we can. And then notes payable will be our liability that we use, and that's going to be the same as the, the debit and credit needs to match. And we'll say borrowed 200,000 over 4 years. Okay. So we have cash. We also have a liability, right? We owe this money back. We're going to repay that over 5 years, and the bank's going to make money, or whoever we borrowed this from, they will earn the interest revenue over that time period. Okay, so that's pretty basic, right? Let's see. Question B, prepare the journal entry to record the payment of the first installment plus interest on June 30, 2019. Okay, so now we're down here on June 30, 2019. And, actually, I'm going to get rid of that because we're going over different years. So let's change the formatting here on the cell. So this allows us to change our date format. The format painter, see how we can see the year now? That's good. And then we can take this format painter, click the button. We want the same format for this one that we do down here. And that just changes it to match. And now we can see 2019, which is a good thing to see because it's the year later we're making the payment. Okay, so now we're making our payment. So I'm going to put the cash in, or let's undo our italics there. Or the first thing I'm going to do is just put in interest expense, format paint again, just to bring this as a debit. And here we can see at this point, the amount of interest that we owe is the $10,000 at June 30, 2019. We're also going to make a payment to the note of principal, and that's going to be our $50,000. And then we basically just add those together, indent for our credit, and what we're saying is we're going to make a $60,000 payment. And I'm going to copy this just to get the italics in there and all that. And we can say to record first installment payment. Okay, so we're making our principal payment, we're making our interest payment, right? If we had been accruing the interest month to month, we would be debiting an interest payable. But this problem tells us we only record the interest expense once per year, which is not really usually, at least in my experience, not how you'd want to do it. You usually want to record the interest every month. So if we were doing this monthly, for example, I'll just give you a quick example of what that would look like. If we were doing this monthly, every month, 7/31/18, at the end of that first month, we would have recorded interest expense and interest payable, and it would have been the expense of $833, the payable going up $833, and we would say accrue monthly interest expense, and then we would continue to make this same journal entry every month end, and it would increase the accrued interest here as we're crediting each month by the same amount to increase it to the point where our last payment would be $10,000. And then at that point, instead of recording a full interest expense of $10,000, we would have already recorded all the subsequent interest. We would have recorded those expenses. And so we would have to debit a payable. And we might do 1 month final interest expense at that point, but primarily the debit would be to the interest payable. So I'm going to delete that. That's just kind of a side note, but I hope to flesh out, the information probably more so of like a realistic type of accounting that would be done for something like this. But yeah, that's pretty much it. And then C says, what would the total note payable balance on June 30, 2019? And we can see we calculated that because of with our table. So it'd be $150,000. How much of the loan would be considered current? Well, if what's considered current here, and I'll I'll put a little extra. Let me put a little extra table down here, and we'll say current and non-current, and we'll say again, you won't have to do this. I'll include this in your version. I'm just kind of creating this as I go. We'll say note payable balance at June 30, 2019. And so our total, let's do this. Our total will equal 150,000. The current portion is going to be 50,000. It's the payment we're going to make within the next 12 months. Let me make that no decimals. So the current portion will be the payment we're going to make within 12 months. It's always within what is happening in the next 12 months is the current portion. And then the non-current portion, then, and we can just do a formula to say everything else. So the non-current portion then is the other 100,000 that's going to be paid after the next 12 months, right? So that next 100,000, which is these two payments, is going to happen in 2021, 2022. We're talking about the end of 2019. So that's how you break out current versus non-current. It's what's going to be, paid within the next 12 months, essentially, when it comes to principal payments. And then why is that important? It's important because then those balances go into separate sections on the balance sheet. The current portion of the debt will be in the current liabilities, and then the non-current portion will be under long-term liabilities or non-current liabilities. And you use those categories to calculate certain ratios, like the current ratio, for example. And so it's important that they're put into the right sections. Okay. All right. Well, that was a long explanation for a relatively basic problem, but I really wanted to flesh this out. So, beyond just doing the journal entries, because there's a lot of information and a lot to kind of grasp about how notes payable work, and most realistically, how you record the interest expense monthly, current versus non-current, note principal versus note interest, and just generally good data and Excel usage in terms of organizing things and using linking and formulas. So, all right. Well, thanks, everybody. I will see you in the next video for AP 5B.